Ladies and gentlemen, good day and welcome to Rishabh Instruments Limited Q2 and H1 FY26 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance and they involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Narendra Golia, Promoter and Executive Chairman, for his opening remarks. Thank you, and over to you, sir.
Thank you. Good afternoon, everybody. Thank you for joining this Q2 FY26 earnings call of Rishabh Instruments Limited. I am pleased to talk to you today from Nasik, where the rainy season is over. We have a very nice chilly weather. I'm sure all of you are having good weather. And pleased to announce that with me today I have Dinesh Mustekar, who is our Executive Whole-Time Director, CEO. Vishal Kulkarni, he is the Chief Financial Officer. Mr. Nishant Dudoria, he is the Additional GM Strategy, Finance and PR. And we have representatives from SGA, our Investor Relations Advisors. The financial results and investor presentation have been uploaded to the stock exchanges and company's website. I'm sure most of you have had an opportunity to review these documents. And in light of what we will speak, you may want to ask some further clarification, and we'll be happy to give you this. I am pleased to report that our consolidated revenue grew by about 7.7% in Q2 FY26 and 9.9% in H126 over the year-on-year basis compared to the last year. This was supported by healthy order inflows, new product launches, and an improved geographical mix. Our margins strengthened and profitability increased more than fivefold, which is a very good thing to report, during the quarter and the half year, driven by improved raw material sourcing, enhanced operational efficiencies, and a more favorable product mix. Obviously, credit goes to the team who is working individually on all these things I mentioned. Raw material sourcing is a very big avenue, and we have been successful in getting results out of that. And of course, other operational efficiencies, automation, all that add up to what we are reporting in this call. The standalone Rishabh India business grew by about 12.1% in the quarter. The business continues to gain strong traction in the international market, resulting in a meaningful improvement in both revenues and margins. We expect this momentum to remain sustainable, supported by strong export demand, deeper customer engagement, and successful conversion of new opportunities with value-accretive margins, which show the strength of our portfolio. Lumal SA continued to perform in line with expectations, reporting strong sequential growth of 33% in Q2 FY26 over Q1 FY26. The business remains well positioned for further improvement, supported by ongoing product diversification, new customer additions, and expansion into additional geographies. Lumal Elucas delivered 1% revenue growth in Q2 FY26, while part of this increase was aided by favorable currency movements. Revenues in Polish zloty reflected a planned 10.7% decline, aligned with our strategic decision to exit non-viable low-margin legacy contracts. Several of these contracts concluded during the quarter, enabling us to streamline the portfolio. Consequently, we are working to backfill capacity with high quality and non-automotive business. Though the natural onboarding cycle in aluminum die casting requires time, we remain confident of strengthening the business mix and improving profitability in the coming quarters. The broader Europe market continues to remain subdued as the region moves through a gradual recovery. Demand remains soft across industrial automation and power infrastructure, and government priorities have shifted towards defense spending, creating temporary constraints in some of our key sectors. However, the situation is significantly more stable compared to last year as energy costs have moderated, supply chains are normalizing, and customer decision-making cycles are improving. Though it sounds imperative to say that situation is turning good, some encouraging signs of a more resilient medium to long-term recovery does not look far-fetched. Our major strategic focus continues to remain on new product pipeline. Over the past few quarters, our team across all group companies have been working in close coordination to accelerate our innovation pipeline. Along with product development, geographical expansion remains our second major pillar. We have been steadily positioning ourselves into new markets where Rishabh and Lumal brand previously had limited or no presence. Early traction has been encouraging and several geographies are showing strong demand visibility. Lastly, I want to reiterate our deep confidence in Rishabh's long-term growth trajectory. We continuously remain focused on operational excellence, product diversification, and expanding our presence in new geographies like Middle East, US, and Southeast Asia to ensure sustainable and profitable growth. US obviously has been a challenge for everyone, likewise for Rishabh, but we have found out a solution between our customers and our office in the US on how to address the issues which Trump has created over the last couple of months. We have been in this industry for decades, and while business cycles come and go, we have consistently emerged stronger, more resilient, and better positioned. Despite the external changes, we remain firmly committed to our guidance for the year and deliver consistent, sustainable value to all our stakeholders. I hope I have given you a correct position of where we are, and I will now hand over the mic to Dinesh Muslikar for his opening remarks. Over to you, Dinesh. Please carry on.
Thank you very much, sir, for that very remarkable opening note. And good evening, or rather good afternoon, ladies and gentlemen. I am pleased to share that we have had a strong start to the year and have sustained this momentum into the current quarter. As Mr. Narendra Golia said, the consolidated revenue grew by 7.7% for the quarter and 9.9% for the half year on a year-on-year basis, supported by healthy order inflow, new product launches, and an expanded geographical mix. Apart from the top line, our EBITDA for H1 FY26 stood at rupees 61.8 crores, which is almost close to what we had done in the complete financial year last year. This is in line with our guidance provided at the beginning of the year, and we remain confident of achieving a full year target of rupees 100 crores in terms of EBITDA. The performance of H1 FY26 provides a solid run rate and reinforces our outlook for the remainder of the year. Our standalone business delivered a strong performance with revenues increasing by 12.1%, as you heard, during the quarter and 14.6% during the first half of the year on a year-on-year basis. This growth was driven primarily by robust export demand that we had, deeper customer engagements, and successful conversions of some of the new opportunities which we were working in the last quarters. The standalone margin expanded significantly to 26.1% in Q2 FY26, a year-on-year improvement of 950 basis points. This strong performance was supported by improved raw material sourcing, which we talked earlier, enhanced operational efficiencies, disciplined cost management, and favorable product mix, and benefits of operating leverage. So it's not just one or two reasons. We have been firing in all the barrels to get this really significant EBITDA level of 26.1% after first half of the year. The standalone EBITDA margins have strengthened steadily over the past 6 quarters, from low as 11.5% to 11.5% in Q1 FY25 to 26.1% in Q2 FY26, driven by the above combination, and continue to support margin resilience to reinforce our long-term profitable outlook. We also remain very optimistic that this momentum will continue throughout the remainder of the year. And in Lumel SA business, performance is in line with our expectation, showcasing a solid quarter-to-quarter sequential recovery. So if you remember Q1 of this year, Lumel SA, we had some drop in sales compared to the last year, but we are confident about our order pipeline, and we have grown our revenues by 33.6% in Q2 FY26 over Q1 FY26, reflecting a robust and progressive growth. On a year-on-year basis, the revenue grew by 10.4%. We remain strongly positioned for further progress, supported by a broader product portfolio, a growing customer base, along with entry into new geographies. The business continues to demonstrate healthy profitability with EBITDA margins at 24.4% in Q2 FY26. So in short, Rishabh is delivering around 26%, and Lumel SA, which is our second biggest electronics pillar, is also delivering us at 24.4% EBITDA level. In our assessment, European markets continue to experience sustained pressure, particularly in electronic automation and power-related segments, as government priorities have shifted towards defense spending in the recent quarters. Limited public investment in infrastructure, upgrades, and automation has further muted industrial demand, resulting in deferred capital expenditure across automation segment. To mitigate these headwinds, we are intensifying our focus on faster-growing markets in Middle East, Southeast Asia, Americas, where demand conditions remain more favorable and offer stronger growth viability. This I am talking for Lumel SA, where we are focusing on exporting the products which are manufactured in Lumel SA in Europe to other geographies other than Europe. Moving on the high-pressure die-casting business at Lumel Alucast, this segment reported a year-on-year revenue increase of 1% in Indian rupees for the quarter. In terms of its home currency, which is Polish zlotys, revenue declined by 10.7% in Q2 FY26 and 4.3% in H1 FY26, in line with our internal expectations. This decline was a direct result of our strategic decision to phase out large loss-making legacy contracts that did not meet our margin thresholds. The exit was deliberate, disciplined, and fully aligned with the roadmap communicated to you earlier. On the profitability front, the improvement has been encouraging. Adjusted EBITDA for H1 FY26 increased to rupees 78 million, compared with a loss of rupees 128 million in the previous year, reflecting a structural benefit of eliminating non-viable business, tighter cost controls, and enhanced operational efficiencies. Q2 FY26 adjusted EBITDA remained broadly stable, consistent with expectations given the ongoing transition in this business mix. Further, the planned phase-out of loss-making contracts will temporarily weigh on revenues in the coming quarters, which we have told you repeatedly, and Q3, Q4 may reflect some losses, consistent again with our guidances which we had given earlier. This vacant fungible capacity released due to the exit of legacy contracts is being effectively redeployed towards healthier profitable automotive and some non-automotive higher value opportunities. This is what is the work in progress now. This transition is progressing well, supported by advanced discussions with global customers, and over 50 RFQs are already submitted in the last quarter. As the nature of this industry involves qualification, commercial alignment with global OEMs follows a multi-stage process, and therefore entry cycles require time from confirmation to delivery. But nevertheless, with strong and improving pipeline, we expect EBITDA margins to remain positive, a small positive this year for this business, and business will encapsulate Lumel Alucas for stronger and more sustainable financial year 27. Moving on the segment-wise performance, the EEI, Electrical and Electronic Instrumentation, which we started reporting you from few quarters ago, this business has delivered 10.8% growth year-on-year in Q2, with adjusted EBITDA margin exceeding 25%. As I told you before, Lumel SA and Rishabh are two big pillars, and both of them are around 25%, reflecting the strength of our product portfolio, improved product mix, and continued operational efficiencies. With sustained momentum from new product launches, the expanding geographical coverage, we remain confident of achieving about 12 to 15% top line growth in this electronics business by end of this year. Further, on high pressure die casting segment, our business is undergoing planned transition, and we are working aggressively to drive new business. We remain confident that the opportunities currently under negotiation will progressively fill the vacated capacity. The ramp up of these high margin contracts will also take place in the coming quarters. But the trajectory of pipeline, quality, and customer engagement level, all of them remain distinctly very, very positive for the coming quarters. From an overall group stance, we continue to drive efficiency enhancement across manufacturing locations, from procurement initiatives to cost and manpower optimization. We are consistently working on to improve margins along with productivity gains. For example, the product lead times, which were for 2 to 3 months, have been reduced to about 2 to 3 weeks now in the last few quarters, driven by tighter planning and enhanced production workflow. Inventory days and quarterly quality related costs also have declined substantially in all our operations, contributing to margin stability. So that's where you can see that the margins which we have been increasing, in particular in our electronics business, have been sustainable. On the expansion, CapEx in India is developing well with erection of 2 new 5 and 7-story buildings. 50% of this work is executed now, which are expected to be completed by mid of next year. Upon completion of these facilities, will effectively double our production capacity, enabling us to meet rising export demands and support stronger growth trajectory of our Indian operations also. Then we also pleased to report reassuring progress in our solar business. Our recently launched single-phase inverter received an exceptional response at a major industry exhibition. This is the first exhibition where this product was displayed into the industry, generating a very healthier pipeline. And in the exhibition stall itself, we were able to book close to 1,000 orders there. So it was really very well accepted by the industry, and we'll be building our capacity and also take more of this product in the future. The early traction reinforces strong potential for this segment and validate our strategic investment in the renewable energy space. And also on our R&D front, the teams are working progressively. As we said that we have 5-year product development plan, and out of which the energy meters which are used in Europe, which are called as the MID meters, they have all been launched, and there is a lot of order booking which is going to happen from European customers for this. And apart from that, medium voltage segment also, we are coming up with a lot of new products which will be launched very soon in the next financial year. Apart from this, our China operations also has on the verge of launching 5 new products, which will also increase their portfolio around the globe. Overall, this has been a quarter marked by disciplined execution and meaningful strategic progress across the organization. Despite global uncertainties, we continue to deliver steady growth, strong margins, and improved profitability, underscoring the resilience of our business model and the strength of our teams. More importantly, we remain fully committed to the guidelines provided for the year. The visibility we have on the order book, cost efficiencies, operating leverages, and evolving opportunities in newer geographies of Middle East, US, and Africa give us a strong confidence in achieving our stated targets, which were to achieve about 100 crores of EBITDA by end of the financial year. As always, I also want to take this opportunity to extend my sincere appreciation to all our employees around the globe and our customers, partners, and you guys as shareholders for your continued trust and support. We look forward for delivering a stronger and promising performance ahead. With this note, I would now like to hand over mic to Vishal Kulkarni, our CFO, to discuss group's financial performance in detail. Over to you, Vishal.
Thank you, sir. Thank you for the detailed overview. Good evening, all. Let me just give a brief snapshot on the financial performances. During Q2 of financial year 26, standalone revenues stood at rupees 660 million compared to rupees 589 million in the same quarter last year, which has delivered a 12.1% year-on-year growth. For half year financial year 26, revenue came in at rupees 1,278 million, reflecting a 14.6% year-on-year increase over H1 of last year. The company reported a strong improvement in profitability. EBITDA for the quarter FY26 second quarter was rupees 172 million, rising by 19.9% year-on-year, with EBITDA margin at 26.1%. This has 1,075 BPS higher than Q2 of FY25. For H1 FY26, the EBITDA was rupees 315 million, a growth of 108.8% year-on-year, with margins at 24.6% compared to 13.5% in the previous period. The PAT for the Q2 FY26 stood at rupees 126 million, which has grown by 85.4% year-on-year, while PAT for half year FY26 was rupees 225 million, registering a growth of year-on-year growth of 113.9%. The standalone EBITDA margins have been improving steadily from past 5-6 quarters due to enhanced operational discipline, improved mix, efficient procurement, and the benefits of operating leverage, all contributing to stronger and more sustainable profitability. Now, the consolidated performance for Q2 FY26, we stood at the revenue rupees 1,963 million, delivering a 7.7% year-on-year growth. For H1 FY26, the revenue amounted to rupees 3,867 million, reflecting 9.9% year-on-year increase over the previous year. The EBITDA for Q2 FY26 was rupees 334 million, marking a 220% year-on-year growth, with EBITDA margin at 17%, 1,129 basis points higher than 5.7% in Q2 of FY25. For H1 FY26, EBITDA stood at rupees 618 million, up by 244% year-on-year, with margins improving to 16% from 5.1% year-on-year. The profit after tax for Q2 of FY26 came in at rupees 221 million, which has increased by 475% year-on-year, while PAT for H1 FY26 was rupees 417 million, a substantial 492% growth year-on-year. The consolidated EBITDA margins have continued to strengthen, supported by the successful turnaround of the HPDC business at Lumal Alucast and growing contribution from the high margin EEI segment. Now, I will give you the company-wide performance. Our Polish entity Lumal SA has delivered a steady performance during the quarter and the first half of the year. The Q2 FY26 revenue stood at rupees 615 million, reflecting a 10.4% year-on-year increase while H1 FY26 revenue was rupees 1,072 million, showing a modest 1.6% year-on-year growth. The EBITDA for Q2 FY26 was rupees 150 million, which has up by 33.4% year-on-year, and for H1 the EBITDA stood at rupees 203 million, registering a 3.3% year-on-year growth. The EBITDA margins expanded to 24.4% in Q2, as an improvement of 421 basis points, while margins for H1 FY26 were 19%, which is higher by 30 basis points on a year-on-year basis. The PAT for Q2 FY26 was rupees 113 million, up by 41.9% year-on-year, and for H1 FY26, PAT stood at rupees 150 million, reflecting a 3.7% year-on-year growth. For Lumal Alucast, the revenue for Q2 FY26 stood at rupees 590 million, reflecting a modest 1% year-on-year growth. For H1 FY26, revenue was rupees 1,349 million, which has grown by 5.6% year-on-year. The EBITDA loss for the quarter narrowed to INR 1 million from a loss of rupees 82 million in the same period last year. For H1 FY26, adjusted EBITDA turned positive to rupees 78 million compared to a loss of rupees 128 million last year, with adjusted EBITDA margins at 5.8% for the half year. The PAT for Q2 FY26 remained negative at INR 21 million compared to a loss of INR 99 million last year. For H1 FY26, PAT stood positive at rupees 41 million, a strong improvement from the loss of rupees 130 million in H1 FY25. On the consolidated level, we remain net debt-free with a strong balance sheet. The net cash and cash equivalents as on 30th September 2025 stands at rupees 121 crores. A healthy cash flow from operations is rupees 626 million as of 30th September 2025. With this, I shall now leave the floor open for question and answers. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We will wait for a moment while the question queue assembles. The first question is from the line of Kiran from Table Tree Capital. Please go ahead.
Thank you for the opportunity. Congratulations, sir, on a great set of results. Awesome turnaround from what we had in the first half of last year. So kudos to you and your team. Sir, I had a couple of questions. One, Lumen SA and the other electricity pumps and everything else. In H1, we grew about 7% to a total of 124 crore. Do you expect a similar run rate for the second half as well, or do we see a slowdown given the Europe slowdown and everything else? The 124 crore, could it repeat in H2 as well?
You're talking about Lumen SA?
Yes, sir. Lumen SA and the other electronics. I mean, basically the way that I got it is India is about 128 crore for H1. Lumen SA and other geographies is 124 crore. Aludicast is 134 crore. H1.
Yeah. Lumen SA, you're absolutely right. The European market is stressed and there's a slowdown and all those things. So we have pretty good confidence of delivering similar numbers for H2 also. We tell that because of a few reasons. Number one is, you remember that last year we declared that there's a 50 crore order which we picked up from German market, which is under execution, and part of this business in Q2 is also coming from there, and that will be there for the that supply will be there until end of this financial year, and also until December 2026. And then, of course, there will be tender again. We may win, we may not win. So that's a separate thing, because our customer has to win and then we can get. So there's a big base of that. That's number one. Number two is, as I was mentioning in our presentation or the speech. So what we are doing is we are focusing Lumel SA business, which was like about 40-50% was in Poland, and about 30 to 40% was in rest of the Europe, and only about 10% was outside of the European border. So our engagement in Middle East market, Southeast Asia, India also, I mean, Lumel products also can be sold in India, and then US market. This is something which we are working extensively. So I personally also had traveled to all these regions to look at opportunities for all our company's products in every market. So we have kind of created a matrix, which products we are doing good in which region, and which company product we are not doing good, and we also have a presence there. So we'll be leveraging in all of that, and in a kind of a matrix sales network. This is all happening now. So Lumel SA businesses will expand more in Middle East, America, and Southeast Asia. So that should be there. So I don't feel, I don't have even an iota of doubt on Lumel SA numbers, but it's not going to be easy. But we have our plans in place, and we'll get close to what we have delivered in H1.
Just to add to what Dinesh said, we have got many distributed customers. Unlike the aluminum business where it is focused with 6, 7 or maybe 7, 8 major customers, the electrical business both in Lumel and in Rishabh is very well spread out. So although there are a few big orders like Dinesh mentioned about this European order, but otherwise the business is very, very distributed, and therefore even if 1, 2, 3 do not deliver or do not pick up what they have done in the last half year, somebody else does that. So I really see no reason why to doubt the second half, and that has also been, in fact, the last quarter is usually very good. The last quarter is good. The last quarter means the third quarter will be good for Lumel, because that is the year end, normally December. And the fourth quarter is good for India because, our year end is March every year. So that also helps us a little. But otherwise, the product, the distribution, the new product that we have introduced, all these add up, and we should be able to repeat the performance of the first half of the year, if not improve on that. Thanks.
Yeah, absolutely. The diversification is on the geographies, on the products also, on the industries also. So it gives us, a lot of buffer, I would say. So if one geography, one product group is not doing, so we can pitch on the other one. So this is absolutely true.
Perfect. Wonderful to hear, sir. Second question, sir. Margins have dramatically improved both in the electronics business. Of course, die-cast has its own challenges, so I'll not ask about die-cast. But the electronics business, both in the India space and the Lumel space, India space we delivered in the H1 24% EBITDA margin. In Lumel SA we delivered 19%. Which is probably the 24% I don't think we have ever achieved since listing in terms of margins for the year. So what led to these margins? One is raw material procurement that you said in the opening remarks. Is it product mix? And the follow-up question essentially is this margin sustainable, or this is like a one-off big order, high margin order, and we revert back to the 20% both on India and Europe business?
Yeah, no, I'll answer that. It's first to answer it in short. Yes, it is sustainable, because this is not just come out of something. It was systematically planned over last 1 year, particularly in Rishabh. So the whole procurement has been challenged, and we have taken out about 4 to 5% cost out of procurement cost. So this is for good and sustainable. Second thing is on the manufacturing and the operation side, the whole reorganization has been changed, and we have taken some labor cost, and also, and in fact, I would rather say that we did not add additional labor for supporting the growth. So that is one systematic system improvement which is done, and it also reflects from our inventory levels, which had shot up to about 6-7 months to 3 to 4 months now. So this is again, and then on-time deliveries have improved from 3 to some of the product lines we had about 3 months, and they've all fallen to about 2 to 3 years. So there has been an organizational change which has taken place. The systems have been introduced. We are more leaner than what we were before. Quality costs have gone down. So many things are there, and there is still a lot to be done. So these numbers which you see from Rishabh is sustainable. This is one part of it on the operation side. Second part is, of course, our sales of some of the high margin products have been bigger. We had, for example, we supply Pronutec, one of our customer in Spain, which has got high margin, and we had a bigger mix of that export going from Rishabh, so that helps a lot. And then we also did not sell too much of EMS and also solar businesses in the first H1, because we are working on optimizing the cost, which has been done. So we leveraged those in the coming years. But all said and done, so 20% is anywhere between 20 to 22% is sustainable. Beyond that will depend on some of the product mix and other things where we don't have too much of a leverage. So I would put that margin enhancement coming from two aspects. One is what is internal, where we have control. Second one is external, where it depends more on the market. Internal things are cost of procurement, our cost of manufacturing, basically operational efficiency and all those things which I spoke. This is all done, and it is done for good, and it keeps on improving. Second thing is the product mix. This is more coming from the market dynamics, etc. So it has some leverage. So I think overall 20% give and take is sustainable for electronics business. This argument is absolutely true for both Lumel SA and Rishabh electronics business.
Perfect, sir. That was a very elaborate answer. Thank you so much for that. My last clarifying question, sir. We have grown in the EI business, both put together, like you classify. H1 we grew about 17%. In your opening remarks, you said anywhere between 12 to 15%. H2, do we see a slowdown, or we continue to maintain a similar run rate and will end up at 17%?
Yeah, I think we should see. We want to be a little conservative in saying that. So we want to have a similar run rate about on the top line. 15 to 17% is what we are looking at. So as we said that top line is more based on our external conditions also. Like for example, US market. Last year we did $2 million there, so we were targeting for $4 million. So it will be $3 million, still a 50% growth, but we have to readjust it. So there are some things which come up like that because of tariff issues, etc. So as Mr. Golia spoke in his remark, we have ensured that we have a strategy put in place to take care of those kind of things. So overall, I would say around 15 is what you can really consider. Domestic business in India also, we have had some of the tenders and projects which are more seasonal are shifting from one quarter to another. So I think we should be around 15.
Got it, sir. Thank you so much. I'll join back in the queue.
Yeah, thank you, Kiran.
Thank you. The next question is from the line of Pratik Giri from Shubh Lab Research. Please go ahead. Mr. Pratik?
Hi, I hope I'm audible.
Yeah, you are audible.
Hi. Hi everyone, greetings. Dinesh, good set this quarter. I have one question on growth which probably you have already alluded to. My other two questions are on CapEx. Dinesh, we have been seeing this, fund utilization dragging in our quarterly results for probably past 4-5 quarters. I mean, to me, it seems that there has been some delay in the capital expenditure which we have been doing in enhancing the capacities. So, yeah, can you help us understand, is it going as per the plan? I mean, have we planned this to drag upon us for so long, or how is it happening there, Mr. Dineshji?
Yeah. So, there were about 70 crores of IPO proceeds, which were for capacity expansion. 60 crores, around 16 were approximately, I'm telling, for corporate utilization, which have all been utilized. And then there was about close to about 55-60 crores for the building construction. So those buildings, which are one is in both of them are in Nashik. One is in Satpura F1, where we have our current manufacturing. The other one is at a place which we call as Trishila, which are about few kilometers, 2 kilometers apart from there. Both these buildings have been constructed more than 50% now, and these buildings are expected to be finished by March, April 2026. So we are at the stage of casting the last tab, and inside work is also going on. Lifts are being ordered. So this is all going as per scheduled plan. So to build a construction like that, 1 year is what is minimum needed, and we are doing it in 1 year's time. And after this is done, then to make these buildings operational, we may take a few more months. So in short, if to tell that out of that 60 crores which is there, more than 50%, 55% of that approximately it's already utilized, and the remaining will be utilized. Most part of it will be utilized by the end of this financial year. Some may skid to next financial year. So this is all going as per plan, and anybody is welcome to come and visit Nashik and see those things. Maybe in the next presentation we can put the photos of those building status also, if we can give some more details on that. So that is all going as per the plan. There is absolutely no delay or nothing on that.
Just to add to what Dinesh said, see, the starting of the buildings takes a lot of time. One is the planning and one is the approval from MIDC. MIDC approves all the plans. And India being India, a lot of babugiri happens. And we did not want to start the building without getting the plan approval. Unnecessary, then we could have some problems. So that really took time. What you say is right, that you are hearing this for the last 5-6 quarters. But the real work has happened in the last, let me say, 6-7 months, 7-8 months, where the RCC is complete for both the buildings, tiling is complete, some windows have been put. So a lot of work has been done, but still, there is cranes to be put in the place, lifts are to be installed, some more work has to be done in the building, and then shifting all the production and making sure that all the areas are available. So as Dinesh said, most of the work will be done in this year, but the real value of the construction and the added capacity and all, that will only come in FY27.
Understood. Understood, Gulia.
27 and subsequently.
No, understood. I'm glad you agreed to the point that probably the IPO happened in September of 2023, if I'm not wrong, and it's already 2 years since we have raised money. So definitely there's some delay, but I totally get your point that this is because of the reasons out of our control. Dineshji, my second question. Yes.
Go ahead.
Go ahead.
Dineshji, my second question is on, the newer pursuits which we had taken, which we have been taking for the last 2 years. Actually, this question revolves around growth only. Because if you see last 4-5 quarters, we have been at the run rate of 110, 120, 130 crore per quarter. Last 4-5 years, definitely the growth CAGR has been good, but for past 4-5 quarters, it has been little subdued. So if you can help us understand, when will the efforts start, giving us fruits? Because solar business also, if I see, probably the revenue has not picked up materially as it is missing from the PPT. So if you can help us understand, how do you look at it?
Are you talking specifically about Rishabh Instruments in India, or are you talking for the whole group? Just clarify your question.
Gulia, I'm talking about our electronics business per se. Consolidated electronics business.
Yeah. So electronics business, last quarter was really challenging for Lumal SA, and then reflects in the whole this thing. But this year we have got away from it. Solar business, you have correctly stated that we had real challenges. China is flooding the Indian market. We were not cost competitive because our technology was from Europe. We had to redo the whole technology. In fact, if any of you are interested, I would really invite you to come and see the work which is done. The whole thing has been made in an aluminum casing, which is very good for heat dissipation, which is very good for cost control, and it is very good for low failure rates. Now, all that work has been done up to about 20 kilowatt, and the above work is still to be done. So that is what Dinesh said. We have booked orders for about 1,000 pieces up to 20 kilowatt. You will see the results. It is delayed. Okay, first thing I accept your observation that solar has not taken off the way we had thought. We had thought that in 2-3 years' time we would have substantial growth in the solar business. But we had to take this thing forward, and this is, I think I told you in one of the earlier conference calls, in every product that we develop, we face headwinds, we face challenges, we face competition. Only thing is we learn from what we are doing and then quickly try to solve that exactly what we are doing in the solar business. That we had a lot of challenges from the Chinese people. They were flooding the market. Government doesn't allow. Make in India is compulsory. So they were getting in CKD, SKD, full PCBs. But anyway, we are in a real market, so we don't want to crib about the competition. Competition teaches us many things. We have learned many things. And now we are back with a vengeance, So yes, it will take another 2-3 quarters, maybe another 3-4 quarters, if I can tell you honestly. But solar business will be a very good, investment we have made. Similarly, Dinesh talked to you about mid-meters, We spent nearly 1.5 crore in getting the approval for the European market. And also we had to do a lot of changes in the product while they were undergoing these tests. All that is done. We have the certification today. We have started selling it. It hasn't picked up, but for sure it will, pick up. The third is we made energy meters for US market. Even that was a very big project. We went through a lot of approval. All these things, the approval is even, I would say, a bigger challenge than the development of the product. Development of the product is a challenge, but bigger than that is getting approvals, interpretation of some of the laws which they make, which doesn't come out. I personally visited one of these testing labs in Europe to clear some of the doubts that they had. But anyway, that's all part. Have all the clearance. So this growth will come about. What you rightly pointed out, that if you see last 4-5 years, there's been a good growth, but the last 4-5 quarters hasn't been that great a growth, We have been around 10, 12, 13, 14%. But I'm sure we will come back to our normal growth pattern. And yes, we have to be patient, but you will see it,
Understood. No, point well taken, Goliaji, because if we look at the power sector companies, I know we are not directly linked to the transformers, etc., but at least we are a part of this value chain. So, hitting or rather clocking a revenue growth of at least 12-13% is what we can expect. But I get your point. Both the questions are answered. Thanks a lot and good luck to the entire team. Dineshji, thanks a lot.
Thank you.
Thank you.
Thank you. The next question is from the line of Zaki Nasir from Nasir Investments. Please go ahead.
Sir, good afternoon and big congratulations for a very strong set of numbers. Goliaji, the question is from it's been 2 years since our issue, and of course we've seen a few quarters of disturbance. But sir, what would you want to see the company Rishabh as 3 years hence, sir?
Isn't the answer very obvious, what I'm going to give? But anyway, I will try to elaborate on it. See, growth has to be there. I mean, if you see, Rishabh, what we started 35 years ago to today, there has been a steady 25-30% CAGR if I take it out. Obviously, earlier years was higher. And as we become larger and as we have subsidiaries all over the world, it becomes more challenging to keep up that CAGR, So I would say realistically, if we plan about 20% and deliver 22%, I'll be very happy, 22% CAGR on the top line and maybe 25% in the bottom line, because bottom line we have more control, there are more things we can do, and obviously overheads don't increase as fast as the top line increases. So let's say 20 to 22% would be our aspiration to do on the top line and 25% on the bottom line. This year we have delivered much more, but this is an exceptional year. I don't think we would try to achieve that year by year.
And sir, your thoughts on... Yes, sir. Yes, sir. And sir, your thoughts on what you would want the outcome of the aluminum business, aluminum die-cast business, sir? How would you take that forward, sir?
No, see, aluminum business has been a profitable business for years together. Yes, last year was a disaster, because of some of the things which happened in Europe, some of the things which happened with our customers, the EV business, our customers, they went, let me say, largely after EV business, and that has been all taken away by China. So they suffered, and when they suffer, obviously, as a vendor to them, we suffered. But now, as Dinesh has been rightly telling you again and again, and he has been working very hard on this, in fact, he spends more time in Poland than he spends in India. And the reason is that we have to come back to customers who give us profitable, sustainable business. And this happens without the automobile. Automobile also, auto business also gives us some profitable business. But the non-auto business is really good. So we are working towards that. I think we have got reasonable success. I would not say all the capacity is taken away. Dinesh has rightly mentioned in his speech that we are still working to fulfill the capacity which has been thrown open by the auto. The auto, large people going away, has really left us with about 40% capacity, which today is unused. If I can summarize, Dinesh can give you more exact numbers, but 35 to 40% capacity today is unused, and therefore, the overheads get distributed on a very narrow base. So all this has to be solved. We will solve it, the aluminum business has been with us now for what, 16 years, out of which 2 or 3 years have been bad, but other years have been good. So I'm not negative on the aluminum business, although it is different from our core business, which is the electronic business, and we will get it back in shape. Dinesh, you can add something.
Yeah, absolutely. It's all true, and we exchange notes, and what you have told is all good. And if you look at overall 10, 15 years of the consolidated kind of growth, most of the growth was coming from aluminum die casting, which was 40% of our group's portfolio, the largest company in the company, which was giving 18 to 20% EBITDA, and that's how it has been. Even during COVID period, we were one of the very few companies which were profitable, forget about getting closed down. As we speak today, there are 5,000 die casting machines which are up for sale in Europe.
Yeah, so what Dinesh is saying is a lot of machines are available because the auto business has really gone down in Europe. All of you must have read, Mahle has, thrown away 1,000 people, some other auto companies, even Mercedes is having a problem. So there are challenges, but then we are going away from the auto business. We are going back to automation. We have customers like EBB using aluminum components. We have customers like Siemens. We have customers like Endreshauser, which we have nothing to do with the auto industries. And I think going ahead, we will get our feet back into this business, which has been disturbed for the last, I would say, 2 years. In this year, so you can already see it is much better than what it was last year, but we have to still come back. Today we are at 0-0, no profit, no loss, but we have to bring it back to 18-20% EBITDA margin.
Would you think that next year that will happen, sir?
Would I think next year?
Sir, it will come back to positive EBITDA?
It will come back to positive EBITDA, but not the one we are aspiring. We are aspiring 18-20% like electrical business. That may take a little more time, but let me say this year we may end up with 0, 1, 2% EBITDA. Next year we could be 10, 11%, and then we can come back to 18, 20. But that depends on how successfully we are able to find the new business and fill up the capacity which today is, let me say, lying empty.
Fantastic, sir. Thanks for your optimism, sir. And sir, one last question, sir. See, Rishabh and Lumel both are pedigree names. So what would your thoughts be on co-branding between the two companies, sir?
No, I would not at the moment. See, what happens is both are such legacy brands. People know left, right. Sometimes I'm myself surprised. कहीं भी जाता हूँ तो बोलते साहब आपके products तो हमने electrical engineer किसी को मिलो तो he has used it. So I would not try to change the brand in India. Similarly, Lumel is 1954, and not only there, but even in the countries in and around Poland, the so-called East European countries, Romania, Hungary, Czechoslovakia, the old Czechoslovakia, all these countries. So, it would not be, in my view, it would not be correct, and I and Dinesh have discussed it many times.
Hello, can you hear me?
Yeah, Dinesh, yeah. Dinesh, we are talking about, the brands Rishabh and Lumel. In India we use the Rishabh brand, and in Poland we use the Lumel brand. So he wants my opinion, and my opinion was that these are so well entrenched brands that brand we will not change, but sometimes we do write, Rishabh group of companies and all that. But that is, they say below the line, the brand on the product will remain, I think, for a few more years. We will not disturb that.
Yeah. Can you hear me?
Yeah. Please add, Dinesh, if you want.
So there is a whole brand exercise which is happening last 1 year. So we are trying to project ourselves as a whole Rishabh group of companies with the brand identities kept in those markets. Lumel has got 72 years of legacy, and no other brand can replace it. And it is we sell Lumel products for 20%. Or 20% higher than brands like Schneider in Poland. So it will be foolish to do away with that. Same is with Saifarm, which is 100 and Tinsley. These are more than century-year-old brands from UK market. So we want to nurture those. Rishabh has its own strong equity in India. Microsys we have. So it will be a corporation with a brand, house of brands. And we are projecting as a whole group with diversified brands and diversified this thing. What we are trying to do is not to duplicate the resources. So the R&D resources are going to be like the whole R&D team will be one. So there will be the center of excellence. We don't duplicate that. Sales resources will optimize. Then production also will optimize. Purchases will optimize. So that's where the real value comes from the group being connected. And also we want to encash on the brand legacies which Mr. Golia spoke about, and that will remain like that. And it will be a bad strategy to do away with that. So this is what we are doing. And also very soon there will be a corporate videos and corporate brochures, and all those things are being released to the market, so that we have that whole smaller entities like in USA or China, they are not able to leverage with the size of their company. So we will be getting them into the fold of whole group's strength, and that will also be a strength for them to go to the market.
Thank you, sir. Thank you, sir. Best wishes to Team Rishabh, sir, and Lumel. Thank you.
Thank you.
Thank you. In the interest of time, we are taking the last question from the line of Madhur Rathi from Counter Cyclical Investments. Please go ahead, sir.
So thank you for the opportunity. Sir, I wanted to understand what percentage of our India business would be white labeling versus the export that we did during H1.
So in H1, see, about 50% of our business is domestic. That is all in Rishabh brand. And the export is another 50%, out of which I would say about 20 in the overall, around 20% is white labeling, 20 to 25%. Rest is all.
Two major customers for whom we white label, and I think it will not be more than 20, maybe 18, 19%. One is the
FICO.
controllers that we do, and one is UK American company. I know it has offices in UK and America, and they have been our white labeling customers for the last more than 25 years. So we continue. Both these customers are very long, very good history, and not only they buy what we make, but we also upgrade. When we develop new products, they are happy to subscribe to our new products. So overall, yeah, total of the total turnover, I would say less than 20%.
Got it. Sir, I had a question regarding the working capital management. Sir, so what kind of working capital management can we expect? And sir, what is the reduction can we expect maybe over the next 1-2 years?
Dinesh already mentioned it. If you were listening carefully, now what he mentioned was that inventory has been substantially brought down. We focus on it, and what used to be 6-7 months, of course, a lot of it was also COVID effect. When COVID came, there was a big shortage of electronic components, and we were forced to do. But forget the reasons. The point is that we had 6-7 months of inventory. It has been brought down to 2-3 months. So we should release some inventory, but at the same time, below 3 months will be a challenge because of the simple reason that the variety of components we use is very large, and customers expect, before they place the order, they expect delivery in the sense, 2-3 हफ्ते से ज़्यादा देते नहीं हैं आपको. So you can't order the components after the order is received and make it and deliver it to them. So you have to anticipate. And electronic components is a big variety, although, it seems that we have a very wide basket of products. But within the basket, there are ranges, 10 ampere ka alag, 20 ampere ka alag, 30 amps or 40 amps, 50 amps, 100 amps, and all of them will need different shunts. Now, part of that we have solved by way of backward integration, but we still have a very large variety of components to keep. So whatever we have brought down, I think if we can even maintain that working capital with the increased business, even that we will limit, up to the time that 20-25% business goes up, maybe we can manage with the current working capital. Beyond that, we will have to pump in additional working capital.
Got it. So just a final question from me, sir. How is our new product introduction strategy in the domestic market as well as the export market, apart from the white labeling that we do? Sir, so do we focus on products where the larger players like ABB and Schneider are not present, or we just plan on replicating the product that we sell in our export market to Indian markets where there is not much competition currently?
Question. See, first thing is that we do not differentiate between export and domestic. What we sell in India, we sell abroad. What we sell abroad, we sell in India. So when we develop, except some very specific products like the MID, I mentioned, even that product we sell in India, but the MID approval is not applicable in India. We don't need MID approval. Similarly, the energy meter in US. But these are the exceptions rather than the rule. But otherwise, what we do is we take our own products and we outdate. See, that is a standard theory in engineering or in anything. You better outdate your products before the competition does. So, for example, we have a multimeter. After 6-7 years of selling a particular multimeter, we will come with a newer version with more features, with more compactness, sometimes with a lower cost. So that is being done by our R&D team regularly, rather than to do it need-based or something. New transducers were introduced, new multimeters are introduced now, new MID meters are introduced. So we do that as a continuous process. As much as we develop new products, for example, see, that is why we have a very big R&D team. It's not a small R&D team that we have. In fact, we have a new R&D center within IIT Bombay, because we want to take the help of the IIT professors. So we do that. But even otherwise, as much as we develop new products, like we developed the solar inverter some time back, and now we are doing some other products. But even the existing products are upgraded and updated time to time. Sometimes it is within the same housing, sometimes these are new housing. So a lot of things are done to make sure that we are at par. Of course, some of them are in competition with Schneider and ABB, but like we were making something for EPCOS. Now L&T, the old L&T, the new Schneider, they went and copied it, but that's up to them. I mean, this keeps happening in the market, that I copy your product, you copy my product. So chal raha hai sab. It's going on quite well.
If I can, just to add some more points to what Mr. Gulia suggested or said is, the product development, we have 2-3 buckets in which we do. One is, you develop a product because some of your components are going to be redundant. That's what he said, that you revive your product before it is there. So that's one part of development activity. Second one is you have a basket. When you have a basket, then you extend that basket. Like for example, current transformer. Then you have got lots of types of current transformers, 3-core, this, that. So you expand that basket. And then you have product gaps. So when you have got range of power quality analysis, you may have some product gaps. So fill in those product gaps. So that's another thing which you do. Then that's the second part of development which happens. Third one is you also are interacting with your customers. There is no product existing. Customer has some need. So it may be a replacement of 2-3 products together, or he has something which he wants to measure, or he wants to use it in some particular way. So you get a product idea. There is no product existing. So we do that also. So you have product, and then there is a technology development which is happening. So there are four baskets in which product development happens. One is you upgrade your product because it's going to be redundant. If you don't do it, like iPhones, they keep on coming next version. This is one part. Second one is you have a product gap, you do that, or you expand the product. That is the third one. Third is customer has some need. He has a need, but there's no product, so you develop that. Fourth one is there is some technological breakthrough which is happening. So you will look at that technology, how you can adapt in your industry and product. So all those things we do, and there is a lot of, this is one of DNAs of our company, and this we do very systematically. There's a product development team. There are product managers for each of these product groups, and they have mandate to do the market research and get all those things, and R&D guys come up with any technological breakthrough which is happening. We have regular R&D and product development meetings on monthly basis, quarterly basis. It all happens very systematically. The advantage that we have is we do all that much faster than companies like ABB and Schneider because of the company being very thin, and we are not as big as they are. So the bureaucracy is much lower. So this is where we have a great advantage.
Got it. Sir, thank you so much and all the best.
Thank you. Thank you, everybody.
Thank you.
Thank you.
I now hand the conference over to the management of Rishabh Instruments. Over to you, sir.
Yeah, thank you everybody for taking deep interest. It was a pleasure talking to you. Figures are with you. You all happy to see the figures. We are all optimistic, and not only optimistic, but our work is in the direction where you will see, I hope, much better quarters than you have seen in the last 1 or 2 quarters. Thank you. Dinesh, you want to add something?
No, I just I can reassure what you have said, and we are going in the right direction. There are some challenges in some businesses. They are not going to be. There's not going to be a time when you don't have challenges, particularly when we are running companies. 5-6 operational companies around the world in different markets. One or the other challenge will also be coming. So what is really makes us different is how we manage these challenges and how resilient we are, how strong we are. We want to be the last person in the line. As I said, aluminum die casting, so much bad has happened, but we still are there. We are bouncing back. That's the character of the company. We have had different type of issues in different type of companies at every point of time. We are building a very strong management team, and wherever we had some gaps in the management team, we are filling it with some external experts coming in. We had some good hiring also done, which I reported a few quarters ago. So all that is falling in place and working well. So we are in good direction, and I wish to have your continued support because markets are not in our entire control, but how we react and how we solve that is absolutely in our control. That's what we focus on. Thank you.
Thank you.
Okay.
Thank you, everyone.
Thanks. Bye. Until the next conference call. Bye.
On behalf of Rishabh Instruments Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.